In the crypto space, we're all of course just trying to get rich and change our lives for the better, but who the hell isn't in any space? Imagine for just a moment though, how horrible it would be to actually get rich and then have some criminal totally steal everything from you and leave you destitute once again. This, in short, is why we need crypto regulation, and if you don't want to get robbed for all of your riches, then this is probably the video for you. Don't forget to hit that like button and let's get started. Recently, a lot of people have been saying that cryptocurrency is dead, but actually it's a very new technology and it's still in its earlier stages of development. Bitcoin was created in 2009, which means that it's about 13 years old, and when the internet was created on January 1st, 1983, about 13 years later in 1996, still only about 36 million people around the world had access to the internet.
We're riding on the internet.
Cyberspace set free. Hello virtual reality.
By 1999, however, the internet already had its first bubble. Then when it collapsed, a lot of people lost a lot of money, and people everywhere were saying that the internet was dead. Amazon collapsed, dropping more than 90%, and it looked like it was all over for the information superhighway. Now there's more than 5 billion people around the world that have access to the internet, and Amazon came back to be one of the world's biggest companies. People were still trying to figure out what the internet was going to look like and what it was going to be, but no one could have imagined what it was going to turn into today. And it took further inventions such as the smartphone to really take it to the top.
And here it is.
Today, a lot of the infrastructure needed to implement blockchain technology already exists, and there's already 106 million people invested in cryptocurrency around the world. That's more than 3 times as many people who had access to the internet 13 years after it was first created. This technology is growing at a faster rate than the exponential growth rate that the internet saw through the end of the 90s. And when we finally figure out what it's going to look like, the people who hold on through the volatility of the early years will be the ones who benefit the most from what this technology becomes in the future. Back in the early days of the internet, people would say that it was full of criminals and scams and all kinds of other horrible things, just like crypto. But over time, we found ways to minimize the risk, and by developing the technology together, we sculpted it into a tool that's arguably beneficial for most people. And throughout the years, it has gradually grown to be a safer thing to interact with. Over time, we'll learn how to interact with cryptocurrency technology as well, and we'll learn how to use it. In the earlier days of the internet, most people didn't even know how to type with more than 2 fingers, because you didn't really need to know anyway. The internet was read-only, and you could only read things that took a long time to load, kind of like a slowly appearing newspaper. Now you interact with the internet, and you can make blogs and make videos, and you can watch videos, and it's not just like reading a newspaper anymore. It took time for that development process to play out, and now it has much more use case than we could have ever imagined back in the earlier days. The same thing is going to happen with cryptocurrency, but it's going to take a little bit of time, and I wouldn't miss the ride for anything. Right now, it's still hard for decentralized and centralized industries to work together, just like how in the beginning of the internet, it took a long time for businesses to develop their websites and grow their online presence. What we need to do is to incentivize these businesses to develop blockchain technology and grow their presence in the space so that we can try to figure out the ultimate utility and grow the technology to a point that we can get the experience to a user-friendly level. The only way to get it to that point though is through crypto regulation. Companies won't jump into the space until their shareholders feel comfortable enough staying invested in their companies if the company's future is tied to the crypto markets.
Sure, the prices are volatile, and the reason the prices are volatile is that sovereign funds and pension plans, for all the excitement about Bitcoin and cryptocurrencies, own this much of it, nothing. And they're not going to do that until there's policy in place. You want price stability, you want price appreciation, allow a sovereign running a $200 billion mandate, a 1% position in Bitcoin. That's how you get there. But they're not going to do it until there's policy in place.
I know that cryptocurrency is supposed to be decentralized, and giving power to centralized governments kind of goes against the whole idea. But centralization is inevitable to some degree because if you haven't noticed, a lot of these cryptocurrency projects are definitely not decentralized. What we need is the right kind of centralization and to make sure that that centralization is as limited as possible. Decentralized finance, or DeFi, runs on the premise that cryptocurrency technology can revolutionize and replace the traditional finance or TradFi system that we currently operate within. These projects are essentially attempting to replicate the services of the traditional finance world in a decentralized manner through blockchain technology. This would in theory remove the middleman, giving power and the profit back to the customers, making you profit instead of the bank. One critical part of the DeFi space is stablecoins. Stablecoins are cryptocurrencies where the price is supposed to always be pegged to a less volatile asset, like the dollar, any other fiat currency, larger cryptocurrencies like Bitcoin, or commodities like gold and silver. They can be used to reduce your exposure to the volatility of the market by moving your funds into an asset that won't fluctuate in value as much as the rest of the market. Also, they can be used for staking so that you can generate a higher yield than holding your money in a savings account in a bank. One such stablecoin was known as UST, a stablecoin that you might have heard of. Its value was always supposed to stay at $1, and it could always be used to exit your position from Luna. This stablecoin, however, was backed up by an algorithm, and algorithmic stablecoins are not fully backed up by hard assets. Terra Luna would issue stablecoins pegged to currencies around the world when they were fully developed, supposedly, to make connections between the global economy and the crypto space. But they didn't really get that far. When you would stake your coins with an Anchor protocol, you would make up to 20% interest every year. This meant that if you got a loan from the bank that was less than 20% interest, which wasn't really hard to do over the past couple of years, you could basically print free money. Of course, life isn't that easy though, and the problem was that if enough people didn't enter Luna to pay the interest to the people who were already in, then they wouldn't get all their money and they would panic, pulling out and collapsing the whole project. This is basically the definition of a Ponzi scheme. When somebody realized this, they drained the liquidity of UST, and then they withdrew a whole bunch of money from Terra Luna, and this sent people fleeing and trying to escape, but there wasn't enough liquidity left in UST for people to exit Luna. Withdrawals were frozen and certain whales were rumored to be let out a back door, and then the value of Luna and UST collapsed, and many people lost their life savings and went into debt because of all of those loans they print out to try to print that supposed free money. Not only did this crash the price of UST and Luna, but it also caused a significant downturn in the price of cryptocurrency assets across the whole market. Projects can tell you what they're supposed to do and how they're supposed to work all day, but to know that they're actually doing what they're supposed to do and you're not just being robbed, we need regulation. Regulation can provide clarity about business structure and fundamentals, including transparency on whether a project has adequate funding, and it can also protect you from scams and fraud. It would obviously be helpful to know if a stablecoin is backed up like they say they are, and to know if lending services are legitimate and sustainable. With publicly traded companies, they are held to FASB disclosure standards, meaning that they have to disclose their investments so that you can have clarification on the viability of their company and to know where your money is actually going. Back on June 12th, Celsius froze withdrawals, sending the market into another freefall, and Celsius was a crypto lending platform where you could supposedly get 10% interest. It basically did what a bank does, but the pitch was that it was decentralized and the profits were supposed to go back to the customers. It would take deposits and lend money just like a bank, but it wasn't registered as a bank, so it had no government body overseeing operations or protecting your money in case they collapsed. This means that no one was making sure that they weren't over-leveraged, lending out more money and paying more interest than they were actually receiving. Celsius was not decentralized. It was actually a company with more than 800 employees and a CEO.
Again, over 800 people already on the team.
Essentially, it was an unlicensed and unregistered private bank with no insurance. Having more than 800 employees means that you have to pay them, obviously, and that definitely has to come from somewhere. During the bull market, the company was growing at such a rapid pace that they were unable to manage everything properly, and when the market took a little bit of a tumble, over-leveraged loans couldn't be paid back, and people were unable to withdraw their funds. Banks require you to prove that you're a credit-worthy borrower before you take out a loan, and if you can't pay back the loan, they have insurance to protect the funds of the remaining customers. When a lender is not regulated and they follow shady business practices, then you end up with things like loan sharks and people having their funds frozen to protect the investments of a select group at your expense. Crypto is generally used in a similar way to a bank, and there are already regulatory bodies set up for and created just to protect people who are engaging with specific sectors of the financial industry. Those sectors are the same sectors that the DeFi space is trying to emulate. For example, when lending, there's the FDIC. So if you lend your money to a bank and they mess up and lose all of your money, then you'll be protected, and when a company like Celsius goes down, you won't be financially ruined as a result. With trading, there's the CFTC and the SEC, and they can protect you from companies lying and saying that they're doing one thing while they're really just draining you of all of your hard-earned cash. With regulation, more money could come into the crypto space and prevent crashes like we've been seeing recently. If sovereign wealth funds, insurance companies, hedge funds, and pension funds entered the market, then hundreds of billions of dollars could flood into crypto and it could stay there. Trillions of dollars would become available as investments into the cryptocurrency projects because these institutions have to have federal regulators overseeing the markets they're invested in order for them to invest legally. Also, if the SEC decides that there's sufficient oversight of the crypto space, then we could finally get that spot ETF that we've all been waiting for. And if the government regulates crypto, then it basically means that they've accepted it and they're not going to be banning it anytime soon. So as a result, more institutions and wealth funds would feel more comfortable investing in cryptocurrency projects, and clarity on what is a security and what's a commodity is absolutely essential so that projects can develop within a set of rules without worrying that the money they're spending on research and development will be for nothing when the SEC threatens them upon the release of their next innovative product. A lot of people think that regulation exists just to tell you what you can and can't do so that the government can take away your freedoms. And while we should definitely be vigilant and make sure that these regulatory bodies don't overstep their boundaries, there is certainly a very important role that regulators must play in the cryptocurrency space. I'm definitely pro-freedom, but I'm also anti-robbing people. So I think that to prevent people from being swindled and losing all of their life savings from being stolen from them through seemingly legitimate projects that are being used to funnel your hard-earned cash into some criminal's pocket, we probably need some kind of regulatory framework, and I guess it is probably essential. Don't get me wrong, it's definitely nice to be able to sell at the end of the year, implementing the wash sale rule to claim a loss and avoid paying some taxes, only to buy back into the crypto at the same price and get ready to write it back up. But that does cause volatility for the price, and it often leads to a dump. Also in the crypto space, there's insane amounts of leverage being used, such as 125x leverage trades that people take on when they only think the line goes up. If the line does go down a little bit after that, then it can cause a cascade of liquidations, and the market can tank significantly, causing almost everyone to lose money because of just a few people's greed. 100x leverage trades are regulated out of the stock market, and when that happens with crypto, it'll save us from a lot of the price swings that we've traditionally encountered. You might say that volatility represents the best opportunity to make life-changing wealth in this space, and I do agree with that statement if you can time the markets and you have a lot of time to dedicate to doing so. However, I believe that if you're watching this, then you shouldn't have to worry about that anyway, because we're still very early, and if you just hodl and dollar cost average, then you'll be ready when the biggest players enter the space, and you'll almost certainly never have to worry about money ever again. All you need is just a little bit of patience. Let me know in the comments if you guys think we need regulation so that people can safely invest in cryptocurrency, or if you think the government will just make everything worse. Either way, thank you guys so much for watching. I hope you have a wonderful day. Thank you guys so much for hitting that like button, and I'll see you next time. Bye.